Hello and welcome to Learn Fast with HK. Today I'm going to take you through the inventory turnover ratio using the real financial statements. We're going to take a company and we are going to analyze its financial statements, and based on its financial statements we are going to calculate the inventory turnover ratio. Before we actually go ahead and fetch the financial statements of the company, let's understand what is inventory turnover ratio. Inventory turnover ratio is one of the most important ratios that we see while analyzing the company's financials. What it does is it measures the efficiency by which the company is processing and managing its inventory. The formula for the inventory turnover ratio is cost of goods sold divided by average inventory. Well, cost of goods sold is the total cost of all the goods that the company has sold within the last 1 year, if we are talking about the 1 year financial statements. And the average inventory is the beginning inventory plus the ending inventory divided by 2. So let's suppose if you want to calculate the average inventory as of December 2019, it will be the beginning inventory of 2019. So we can take the December 2018 number, add the December 2019 number, and after adding them, divide both of them by 2 so that we can come up to the average inventory. Now, the example that I'm going to take today is going to be of Apple, the company Apple. And let's go to its website. So let me just go to Apple's website, and let me just go ahead and fetch its financial statements. So the financial statements are generally found in the investors or investor relations section of a website or a company. And generally it is given right at the top or at the bottom. So for Apple, it's given at the bottom. So we have investors over here. I'm going to click on that. Once I click on investors, I'll get all the sets of financial results and the financial statements that Apple has published. And what we are interested in is the 2019 financial statements. The 10K statement is the annual filing that Apple must have filed for the entire year of 2019, while 10Q represents the quarterly filings that the company files. So I'm going to go to 10K, and it is opened, and I'm going to just scroll down a little to go to the table of contents from where I'm going to search what I'm looking for. So I'm basically searching for the financial statements, and here we go. Item number 8, financial statements and supplementary data. So I'm just going to click on this, and it takes me to another menu in which various financial statements are mentioned. So I'm going to go to the consolidated statement of operations. By consolidated, we mean it includes all the subsidiaries or all the companies that Apple owns, and it's the consolidated result of all the companies. So I'm just going to click on that. And this is the income statement of Apple, and we have net sales, we have the item of our interest, the cost of sales. We also call it as COGS. And since Apple sells both iPhone and iPad, so basically Apple sells both products and services. Services are something which Apple sells through App Store, the applications. Uh, so the total cost of sales will be the addition of both the products and services, and it is 161,782 million. So this figure is given in million. It's a million. It's given in million. Sorry. Yes. So it's 161,782 million. That's the figure that's for cost of sales. And let's go ahead and see what is the average inventory for this company. For average inventory, we would need two figures. First is the beginning inventory and second is the ending inventory. So this is the ending inventory because this is the inventory that is at the end of 2019, 4106. And at the beginning of 2019 year, we have 3956. So Apple started with 3956 as the inventory, or you can say the raw material in its warehouse. And it ended the year with 4106 as the inventory. So I think we have all the figures that we were looking for, and I think it's very easy now to calculate the inventory turnover ratio. Um, so I'm just going to go back to cost of goods sold and write down my cost of goods sold over here. So I'm just going to write down the formula for inventory turnover ratio first. Inventory turnover ratio is equal to cost of goods sold divided by average inventory. The cost of goods sold in our case is 161,782. So I'm just going to write that 161,782 and divided by average inventory. The inventory in this case is 4106. So I'm just going to calculate average inventory somewhere here. Average inventory. It's going to be 4106 plus 3956. Sorry for the loss of space. Divided by 2. And let's quickly calculate this on the calculator. So it's 4106 plus 3956 divided by 2, 4031. And I'm going to write this here, 4031. And now let's calculate what is the inventory turnover ratio that comes out to be. It's 161,782 divided by 4031, which is 40.13. Now this is the, yeah, this is the inventory turnover ratio for Apple, and let's see what it means. So 40.13, and in order to find out what it means, let's just do a reverse of inventory turnover ratio. Reverse of inventory turnover ratio, which is 1 by 40.13, or 0.024. I'm going to convert this into percentage, so it comes out to be 2.4%. Now let me just tell you what it means. The COGS divided by average inventory comes out to be 40.13. When we reverse this, this becomes average inventory divided by COGS. So this ratio that you see over here, it's average inventory divided by COGS. Or we can say that it is average inventory as a percentage of COGS, which is 2.4%. Now, if we analyze this, it means that the average inventory that Apple is maintaining in its warehouse is only 2.4% of the goods that it is selling to its customers. Now, the average inventory, which is 2.4% with respect to the amount of goods that Apple is selling, is quite less. It seems to be quite less. But we're absolutely okay if this percentage or this ratio or maybe this ratio is equal to that of industry's ratio. Now, if the entire industry is operating at this ratio, we are absolutely okay because it might be the norm of the industry to keep such low inventory compared to your cost of goods sold. But if it is higher or lower than the industry, then it could be a problem. And let me tell you how it could be a problem. So let's suppose that this reverse of inventory turnover ratio, which is average inventory as a percentage of COGS, which is 2.4% of Apple, which means that Apple is maintaining just 2.4% of the entire amount of goods that it is selling as an inventory, which seems to be quite less. But the other companies in the industry are maintaining 25%. So if other companies in the industry are selling goods worth $100 in 1 year, they still have $25 of goods lying in the inventory so that if any demand comes up, they can just process this inventory quickly and use it to sell it. But Apple very has a very low amount of, you know, inventory with respect to the amount of goods that it is selling. So since Apple does not have a very high amount of uh, inventory as a percentage of COGS, or you can say has a very low amount of inventory as a percentage of COGS, Apple could face problems if in case the demand in the market rises significantly, which means that Apple in that case would have to procure more inventory immediately and then process it and then sell it. And in this process, Apple could lose its sales. So that's the entire problem that Apple could face. On the other hand, if this 2.4%, let's suppose this 2.4% is higher than that of industry. So industry is maintaining 1.1%, not 1.1, but 1%, and Apple is maintaining 2.4%. In this case, Apple is holding more inventory compared to the industry, which means that more cash of Apple is tied in inventory. So here, Apple could face working capital issues or current ratio issues because more of the cash of Apple is tied in the inventory, while for the industry has committed less amount of cash to the inventory, right? So this is what the inventory turnover ratio means. There's another ratio which is quite related to inventory turnover ratio, which is called the days of inventory on hand. And this ratio also measures the same thing. It measures the number of days of inventory. And the formula to calculate it is 365 divided by inventory turnover ratio. So in case of Apple, so let me just shift this a little. So in case of Apple, the inventory turnover ratio, if you remember, is 40.13. And if we want to find out the days of inventory, that will be 365 divided by 40.13, or let me just quickly calculate it on the calculator. 9.095. So I'm going to take 9.1, and this comes in days. So this means that the current state of Apple's inventory is just is that Apple's inventory is enough to produce the finished goods for 9 days only or 9.1 days only, after which it will have to procure additional inventory. So this also tells us the same thing, that Apple is maintaining very low amounts of inventory, and it should maintain higher amounts of inventory, considering that it's the goods that it is selling, the amount of goods that it is selling every year is pretty high. And going by that, it should maintain a higher level of inventory. Now, again, if the industry is also operating at this level, then it's absolutely okay. But yes, if the industry is not maintaining or operating at this level, then Apple should uh, operate as per the industry standards. And otherwise, it could face either the cash flow issues or some other issues related to inventory. And this is how we analyze the inventory turnover ratio. I think that's about it. If you have any doubts or any comments or any feedback, please write it in the comments. Apart from this, we also take online classes. For any queries, please contact me at the given mobile number or email address. Thank you. Bye bye.